Did you take advantage of tax loss harvesting last year, last March, when we had the fastest bear market in history? I hope so, because that would have allowed you to take advantage of some significant tax savings. I'm going to explain what, why, and how coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. If you're on top of tax planning, then you captured an opportunity last year to improve your tax situation. And if you missed it, or if you were asleep at the switch, it was gone in an instant. And that's right. I mean, we had the fastest drop in the stock market ever, the fastest bear market in history, and it was the fastest recovery as well. The best 50 days in the stock market followed the bottom. And so at the end of February last year, the last week in February, everything started waterfall crashing, okay? 1 month later, we hit the bottom. No one expected it to be the bottom. I certainly didn't. And then things skyrocketed off the bottom and recovered extremely, extremely quickly. Well, if you had investments in a non-IRA, non-Roth IRA, non-tax sheltered account, then you could have done some tax loss harvesting at that time. And what I mean by that, before I explain the benefit, let me just set the stage, right? Because we're all coming to this video with a little different aptitude for this sort of stuff. But if you hold investments inside of your 401k, inside of your Roth IRA, inside of an IRA, inside of a 529 plan, those are all tax shelters. So when you contribute to those, okay, the money is now in those accounts, and all the activity that happens within those accounts does not show up on your tax return. It doesn't show up on your tax return until you pull some dollars out, and in the case of a Roth and 529 plan, likely when you pull those dollars out, it still doesn't show up on your tax return, okay? So those are called tax shelters. But if you own an individual investment account, a joint investment account, a trust account, then the activity, all the stuff that happens within that investment account does land on your tax return. So if you buy something low and sell something high, then when you sell it, you have to report that gain on your tax return, okay? And it's taxed at capital gain rates if you held it for 12 months or longer. If you buy something up here and you sell it down here, then there's a loss, and you get to claim that loss up to a certain limit on your tax return as well. And obviously that's just buying and selling. Interest and dividends, that shows up on your tax return every year for these non-tax sheltered accounts, an individual account, a joint account, and trust accounts, okay? So for example, outside of those IRAs, 401ks, I'm not talking about those right now, just individual or joint account or trust account, last year when the stock market started like this, and then did that, if you rebalanced, if you changed some of your investments down here, okay, and then you had a loss most likely on your investments because of how quickly things dropped, then you had a loss depending on your cost basis. And then when things rebounded, now, from this point to wherever the value is right now, you've got a gain in your account. But if you haven't sold anything, then it's not realized. So that's sort of setting the stage. The big idea here is if from whenever you bought the investment down right here, if you had somewhere in here the wherewithal to rebalance your investments, to change some of your investments, then you could have captured a loss. And now, right now, I want to head off those of you that are thinking, why would you sell down here? This guy's crazy. You shouldn't sell down here. I'm not talking about selling down here. I'm talking about changing your investment. If you had a balanced fund that was now at a loss that you could capture some gains and move that money, you could sell the balanced fund and move it into an index fund, voila. Right? Voila, you kept the dollars invested, but you were able to capture a tax loss. It's a wash sale. You're not allowed to capture the loss if you sell one investment and buy substantially the same thing. So you can't sell right down here the Vanguard S&P 500 index fund and buy the Fidelity S&P 500 fund. That's a wash. That doesn't work. You've got to change investments. But if while things were dropping, you had a loss that you could capture, you obviously don't want to sell when things are down, so you could change investments, capture that loss. Now you have a realized loss that you can claim on your tax return, and you have a whole bunch of unrealized gain that you'll have to report on your tax return in the future whenever you sell. Okay, so that's just setting the stage. That makes sense? Here's why this is such an enormous deal. There is a tax arbitrage play at work here. Tax arbitrage. So arbitrage meaning there's a free return you can get here if you just play your cards right. Okay? When you are doing your taxes, and let's just use a simple base sort of example. If you've got $150,000 of income, of other income sources, let's just say that's wages and dividends, whatever. That's what that is. If you have capital gains of, let's call it another $10,000 on top of that, now your income's $160,000. Subtract out, we'll just use $25,000 for standard deduction. So you pay tax on $135,000. That's what you pay tax on. But this capital gains is taxed at 15%. Based on this income amount here, if your taxable income is in the 0%, the 10%, the 12% tax bracket, then your capital gains rate is 0, okay, from a federal level. If your taxable income down here, if you're in the 22%, 24% and higher, your capital gains rate is either 15% or 28%. If your adjusted gross income is above $501,000 this year, then your capital gains rate turns to be 28%. But what I'm saying, if you caught that, is your capital gains rate is going to be lower than your overall tax rate down here, okay? So if you have gains, all right, then you've got your taxable income down here and your gains are taxed at a lower rate. So some people, the reason why I'm making a big deal about this, some people say, well, you don't really need to tax loss harvest because your capital gains are taxed at a lower rate anyway, so you're fine. And anyway, capital tax loss harvesting, sometimes I'll have a gain, sometimes I'll have a loss, it'll all wash itself out. No, here's the power of it. It doesn't wash itself out. Check this out. What if instead of a capital gain, you had a capital loss and you were able to lock in a capital loss of, let's just say, $20,000, all right? And again, you didn't sell that investment and abandon low. You just changed investments at an opportune time. Had no idea the market was going to recover as quickly as it did. It could have kept going down, but hey, we've got a capital loss. It's a meaningful capital loss. Let's change our investment so we can capture it on our tax return. Now, you get to offset any other capital gains against this, okay? But the point I'm trying to make is if you offset all of your gains and you still have some loss there, you are allowed to take up to $3,000 of that loss on your tax return in each year. And then the remaining $17,000 carries forward to the next year where it will offset capital gains. But again, if you are very tax sensitive and you don't have capital gains this next year, then you get to deduct another $3,000 this next year and another $3,000 until it's all used up. Here's why that's so beneficial. Now your income is $147, okay? And you pay tax on, what's that? What's that now? So $122, okay? Now you pay tax at 122. That just saves you, you're in the 22% tax bracket here. This just saved you 22% tax. It allowed a 22% tax deduction. You're allowed to have $3,000 be a deduction against your ordinary income rates versus being taxed at 15% or whatever. Guys, that is an enormous deal. If you've got capital losses that you're carrying, you can use them to offset capital gains, but that helps offset a 15% tax. If you, and we had an opportunity last year, I erased it, we had an opportunity last year with the quick decline. If you were able to capture some of those losses and do tax planning the rest of the year so you didn't have any realized capital gains, you were able to get a $3,000 tax deduction against your ordinary income rates, saving you 22%, 24%, or whatever, depending on your tax circumstance, depending on your tax situation. That's a big deal. That's a big deal. That's hundreds of dollars or thousands of dollars that can be gleaned, that can be saved on your taxes just by being mindful of your tax situation, doing tax planning when it comes to your investments, okay? So that's complicated, doesn't apply to everyone. So how would I apply this to you, okay? Number one, use tax shelters as much as possible. Use tax shelters as much as possible. As cool as this is, as interesting as this is, if you followed any of that, then it's still better to be funding a 401k, still better to be funding a Roth IRA, still better to be funding those tax shelters. Put as much as you possibly can for your overall financial plan, as long as that fits. Put as much as you can into those tax shelters, okay? That's gonna give you the biggest tax benefit. But over and above that, once you've maximized all of that, or if for some reason you need a separate account, then you've got to be tax sensitive with your investment strategy. This is why you need tax planning. So number one, I erased it, but on the way up with your investments, make sure that you're not just buying and selling willy-nilly, that you're actually being sensitive to the taxes. And then when the stock market gives you lemons, make lemonade. When you can do some tax loss harvesting, do so. And then manage your capital gains so that you can actually get a better tax deduction against your ordinary income as opposed to just offsetting other capital gains, all right? Your certified financial planner isn't just helping you with investments. They're helping you with all 6 areas of your financial life. Tax planning's a biggie. Tax planning is a huge one. There's arbitrage. Just by knowing these rules or making this adjustment, you can improve your tax situation far beyond what you could have without, being aware of those strategies. So work with your certified financial planner. Make sure they're giving you tax planning advice. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well. And then you could also just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.